Shriram Finance Limited Q2 FY2024 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star and 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Umesh Revankar, Vice Chairman. Thank you, and over to you, sir.
Thank you. Good evening, friends from India and Asia. A warm welcome to you. Greetings to and good morning to those who are joining the call from western part of the world. I have with me today our Managing Director and the CEO, Mr. Chakravarti, Joint Managing Director and CFO, Parag Sharma, Joint Managing Directors, Mr. Sundar, Shriram, Sudarshan, Nitesh, Mr. Jilani, and Srinivas. Also are present with me Ravi Subramanian, Managing Director and CEO of Shriram Housing Finance, and Mr. Agarwal and Sanjay Mundra, our Investor Relationship Head. It has been an encouraging quarter and first half of the year for Shriram Finance. We are seeing early dividend in our operations of recent merger on the back of introduction of more products across our network. Let me first go to the Indian economy. This economy expanded by a robust 7.8% in the quarter ended June 23. The outlook for FY2024 is a growth of 6.5%. This is based on statistics indicating the strong pickup in consumer demand, good rural demand, as well as steady capital expenditure by the government on infra, which in turn is seeing private sector following the suit. Manufacturing activity too is seeing a strong growth, and IIP for the month of August registering 14 months high of 10.3%. Purchasing PMI index for the August coming to 58.6. The economy is therefore seen to be holding up well. Economic activity appears to be gaining momentum despite global geopolitical uncertainty. Consumer demand appears to be improving further and should be even stronger during the upcoming festival season. The retail inflations in June increased to 7.4%, which was a 15-month high. Now, in the month of September, it is already corrected to 5.02%. At the same time, wholesale inflation was negative in July at 1.4%, which is further, it is now is contracted to 0.26% in this quarter, this month, which is 6 months in a row, which has reduced. RBI in its MPC meeting earlier in this month retained the repo rate at 6.5%, but guided for higher inflation for FY2024 at 5.4% versus earlier inflation of 5.1%. We are witnessing some increase in vegetable price, and that could lead to some increase in inflation this quarter or maybe next quarter. However, we feel the economy will continue to grow based on the strong rural economy. The monsoon this year was erratic. There were excess rains in July and September. There was also deficit in June and August. However, long period average is it's a near normal monsoon. The revival of monsoon in September has raised the prospect of helping major kharif crop and the total area under cultivation was 1107.16 lakh hectare, which is 2.37 lakh hectare more than the last year. Oilseeds in particular have benefited from December's rainfall. The Cabinet Committee on Economic Affairs has increased MSP, that is minimum support price for Rabi crops for the year 24-25 recently, which includes wheat, pulses and oilseeds. So the rural economy is likely to do much better in the coming quarters. The GST collection continued to be robust for the Q2 24. GST revenue crossed 1.65 lakh crore, is high, third highest since GST was introduced, and 11% higher year on year. In August, GST collection was 1.59 lakh crore, and September 1.63 lakh crore, which is fourth highest and 10% year on year. Coming to the auto industry, the commercial vehicles have been quite robust. In this quarter, the total sales aggregated 2,47,929 units, which was higher than the previous year quarter, which was 2,31,991 units, representing the increase of 6.9% year on year. Within CV, M&HCV grew fastest at 17.6% year on year, sales numbering 93.796 number against 79.761 units. LCV sales was 1,54,133 units versus 152,230 units, a marginal increase. Passenger vehicle increased by 4.7% with 10,24,189 units against 10,26,309 units. Within the passenger vehicle, the utility vehicles grew fastest at 23.5, indicating utility and the SUV vehicle demand being the higher. The base model vehicles grew, or I should say, degrew to some extent. Two-wheeler sales were flat at 45,798,442 units against 46,000,931 units. Two-wheeler sales is gradually picking up. What is encouraging is sale of electric two-wheeler, which was 63,715 units in September, compared to low of 45,806 in June, post the reduction of subsidy. Three-wheeler sales grew very strongly, 1,95,200 units sold, with a growth of 62.2% increase over previous year. Tractor is continued to grow at 9.4% over the previous year, with 2,19,106 units sold against 2,316 units in the Q2 of previous year. Construction equipment again registering very good growth of 29.26%, with 27,444 units against 21,231 units same period last year. One significant event in this quarter is launch of our super app, which we have been talking about for last 1 year. The super app named Shriram 1 is now available in both Google Play Store and iOS App Store. We have started onboarding. Initially, we started with our employees using it, and we have started onboarding our existing customers. And slowly, it will be introduced to large number of our customers, which gives them a solution, including the loan payment, investment, insurance, credit score checks, and many other utility functions, which will make them even to do social networking, monitoring and utility payments. Now I request Mr. Chakravarti to take forward the opening remarks.
Good evening, ladies and gentlemen. Thank you, Umesh. I welcome all of you to our Q3 FY24 earnings call. We declared our results for the quarter earlier today, and I trust you have had the opportunity to pursue them, review them, and the related investor presentation, which has been posted on the website of the stock exchanges. As our Executive Vice Chairman said, despite Q2 traditionally being a quiet quarter, this quarter has been encouraging for us. We registered a disbursement growth of 30.91% year-on-year and of 13.63% quarter-on-quarter. Our disbursements in quarter 2 of this year aggregated to 4,605.61 crores versus 6,434.31 crores in Q2 FY23 and versus 30,454.80 crores in Q1 FY24. Our assets under management as on 30th September 2023 registered a growth of 19.60% over Q2 FY23 and of 4.88% sequentially. Our AUM stood at 2,02,640.96 crores as against 1,69,359.08 crores a year ago and rupees 1,93,214.67 crores a quarter ago. Our net interest income in quarter 2 FY24 registered a growth of 7.38% year-on-year and 8.55% quarter-on-quarter. We earned a net interest income of rupees 1,818.18 crore in Q2 this year as compared to 4,104.86 crores in Q2 FY23 and rupees 4,038.68 crores in Q1 FY24. Our net interest margin was 8.93% as against 8.26% in Q2 FY23 and 8.33% in Q1 FY24. Our profit after tax grew by 12.59% in quarter 2 FY24 over quarter 2 last year and by 4.5% over quarter 1 FY24. The registered PAT of rupees 1,007.84 crores for Q2 FY24 as compared to 1,555.11 crore in Q2 FY23 and rupees 1,675.44 crores in Q1 FY24. Our earnings per share for the quarter stood at 46 rupees 67 as against rupees 41.53 in Q2 FY23 and rupees 44.73 in Q1 FY24. On our asset quality, gross stage 3 in Q2 FY24 stood at 5.79% and net stage 3 at 2.8%. These numbers show an improvement over the corresponding numbers of 6.31 gross and 3.32% net in Q2 FY23 and over 6.03% gross and 2.96% net sequentially. Our credit cost for Q2 FY24 stood at 2.02% as against 1.73% for Q2 FY23 and 1.62% for Q1 FY24. Our cost to income ratio was 25.68% in the Q2 this year as against 24.2% recorded in Q2 FY23. Our cost to income ratio in Q1 FY24 was 27.34%. Regarding our subsidiary Shriram Housing Finance Limited, Shriram Housing Finance Limited registered a disbursement growth of 60.93% to rupees 1,688.30 crores as against 1,049.10 crores in Q2 FY23. Shriram Housing's assets under management on 30th September exhibited a growth of 65.23% year-on-year and 13.38% sequentially. Thus, the AUM stood at 10,816.03 crores at the end of Q2 FY24 as against 6,005.92 crores in Q2 FY23 and 9,539.20 crores in Q1 FY24. Shriram Housing's net interest income registered a growth of 51.98% in Q2 FY24 over Q2 FY23 and of 15.27% over Q1 FY24. Net interest income for Q2 FY24 was 7.43 crore rupees compared to 64.11 crore rupees a year ago and 85.27 crore rupees a quarter ago. Shriram Housing Finance registered a profit after tax growth of 1.7% in Q2 FY24 over Q2 FY23 and of 5.63% over Q1 FY24. That second quarter of this year was rupees 58.21 crores as compared to rupees 34.03 crore for Q2 FY23 and rupees 5.4 crores for Q1 FY24. The EPS stood at rupees 1.48 against rupees 1.05 in FY23 and against rupees 1.40 in Q1 FY24. Shriram Housing's gross stage 3 for the Q2 FY24 stood at 1.08% and their net stage 3 came in at 0.83%. In comparison, these numbers were 1.52% on gross basis and 1.15% on net basis. Q2 FY23 and at 1% gross and 0.15% net Q1 FY24. I shall now request our whole-time director and CFO, Mr. Parag Sharma, to inform you about our resource raising activities, after which our joint managing director, Mr. Sundar, will brief you about our accounting aspects.
Hello everyone. On liabilities, total debt stands at 1,65,557 crores, which is an increase of 3,500 crores from the previous quarter. The breakup of the debt is 25% coming from retail FDs, which is close to around 40,800 crores. Capital market, domestic capital market is 21%, which is 35,000 crores. The ECB is both in loan and bond format is around 13% of our liability, which is 31,500 crores. Securitization, which for largely for private sector assets, is 15% of our liabilities and quantum-wise 25,000 crores. Term loan from bank institution is 26% of our liabilities at 43,170 crores. The cost of debt has marginally come down from 8.89 to 8.87 for the as of the period ended September 23. The incremental cost of around 8.7%. The liquidity as of September was 15,600 crores, which is more than the liabilities for next 3 months, which is close to around 13,000 crores. Will be close to around 3.5 months of liability payment. The LCR ratio stands at 219.87% against a regulatory requirement of 85% to be achieved by December 23. The overall borrowing for the quarter has been around 21,000 crores, versus 18,000 crores in the previous quarter. The debt to equity stands at 3.59% versus 3.6% for the previous quarter. The ALM surplus, all buckets have been positive as in past, and surplus up to 1 year is in excess of 58,000 crores versus close to around 27,000 crores in the previous quarter. So we have been raising ECBs, and in the calendar year till now we have done close to around 980 million of ECB borrowing, largely in the loan format. Recently we have concluded 400 million of ECB loans. With this, I hand it over to Sundar for his comments.
The employee count as on 30th September was 71,023 against 1,343 in June quarter. We have increased our employee count by 5,050. Cost to income ratio as on for the quarter September was 25.68 as against 27.34 in the previous quarter. And coming to the ECL numbers, in stage 1 PD was 7.89% as against 8.05% in the previous quarter, and stage 2 was 18.21% as against 18.88% in the previous quarter. LGD was 41.39% in the September quarter as against 42.32% in the June quarter. The board also approved the declaration of dividend of 20 rupees per share, that is 200% dividend was declared in the meeting earlier today. This we hand it over to the become open for any questions.
Thank you very much. We'll now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and one to ask a question. First question is from the line of Maru Kajania from Nuvama Wealth. Please go ahead.
Yeah, hello. Congratulations. So talk us through your margins. Do you see this level sustaining? I know you called out the marginal cost of funds. Do you see this level sustaining? And the share of CVs has come down. So any explanation?
The net interest margins have improved. One is the liquidity, which we are maintaining at 4-5 months, now it is brought down to 3 months. That is negative carry is reduced. That's one of the reasons. And also the certain products which use higher yield, we have been able to increase it. That also has given. So the product mix and reduction of the negative carry, that is the reason for the expansion of NIM. It should continue depending upon the product mix what we end. That is one. And on CV, we have grown 12%. In fact, if you recall, we have been telling that CV will continue to grow between 12 to 15%. And the other products will grow faster. That's the strategy we have adopted. And we are going as per the strategy. So CV will continue to grow and continue to remain mainstay. But the other product will continue to grow faster. But here, if you observe, passenger vehicle have grown faster. So it is between the passenger and CV, the passenger has taken little faster growth because of the bigger demand coming from tier 2 and 3 towns for passenger vehicles. So overall, I feel the growth of all segments will continue to remain strong.
And the share of new CVs?
New CVs, we are taking a position on new CV. It is continued to remain reasonably strong. In fact, we started growing on new CV in the month of, in the quarter of last quarter, continued in the first quarter, and now also it continued to grow. But it will not be a significant number on the overall scheme.
But the share would have reduced this quarter?
It would have marginally reduced because other products have grown faster. That's all. Otherwise, it is continuing to grow at same level.
Okay, sir. Thank you.
Thank you. Next question is from the line of Avinash Singh from Emkay Global. Please go ahead.
Yeah, hi. Thanks for the opportunity. A couple of questions. First one, I mean, if you can sort of again on yield side. So yield seems to have improved a bit. I mean, so there is some shift in product mix. So what sort of a product mix changes? Sort of a new old composition or the others like your PL or gold loan that is have driven up the yield. So if you can just help us understand what has led to this sort of a improvement in yields. That's one. And second, in the credit cost close to 1,100 odd crore numbers. If you can help us understand what sort of write-off is included there. Thanks. Questions.
So on the product, hi, this is Shriram. So if you look at the growth for the 6 months compared to last year, the outliers, I mean, in the sense, the highest growth has come from passenger vehicles, MSME, gold, and of course, personal loan also, which are basically slightly higher yielding products compared to the commercial vehicle. Out of the total disbursement, probably about 12% would be new vehicles and that is old vehicles. So the yields there, I would say the overall yield growth has come because of MSME, increase in MSME, gold and the personal loan products. As far as the credit cost is concerned?
Yeah, the write-off during the quarter was 839 crores and the provision was 289 crores, totaling to 1128 crores.
No, what he's saying is different.
Yes. You said 289 crore is the provision,
839 crores of write-off and 289 crores of provision.
Okay. And the yield improvement, I was talking more from quarterly sequential. I mean, from Q1 was also improved. Right? I mean, if I see CV has got down, PV has gone up a bit. I mean, yeah, and personal and others have largely been stable. So, yeah.
The numbers I gave you are over the last 2 quarters.
Okay. Thanks.
Thank you. Next question is from the line of Shriram from Equirus Security. Please go ahead.
Hi, sir. Good evening and congrats on the numbers. Question was pertaining to yields again. Could you please highlight any hike we would in the last 2 to 6 months for CV and PV segment?
No, we have not taken any rate hike there. We have held our rates. It's just a change of mix of products that has helped us in the yield side.
Okay. So, sir, what is our pricing in the new CV and used CV and PV segment currently?
It ranges, the new CV ranges anywhere from 11 to 13%. And old CVs would be again 13 to 15, 16%.
And MSME?
MSME would be again same thing, 14 to 20%.
Got it. So
range depending on the security, the customer profile, it's range.
Right. Sir, just on margin guidance front, so we were earlier and for the year end we would see 5% margin, but with this liquidity related change in approach, brought down the balance sheet as well as change in product. So where do we see the margin moving for the year end?
We would like to continue with our guidance on 8.5, but yes, depending upon the market situation, it can vary little. So it should be anywhere between 8.5 to 9.
Okay. And so just last question, during this quarter we had 5,000 employees. So is it onboarding of new employees only, or is there anything else?
It's onboarding of new employees only.
As in from fresh employee pool from
mostly,
the
majority of them, 97% of them are feet on street.
Okay. Sales role. Okay, got it. Thank you so much. Good luck for the next quarter.
Thank you. Next question is the line of Gaurav from Mirae Asset. Please go ahead.
Yeah, hi, good evening, sir. Congratulations on the quarter. Questions from my side. On again margins. Here, I think level of liquidity today is around 10,000 crore, which is 6.5% of your borrowings. So going forward, would we expect similar kind of liquidity now? That will maintain 6.5% of borrowings, which is essentially 3-month liquidity cover.
Yeah, that's a policy of the company, and we will maintain it.
Got it. Got it. And just on this, the LCR ratio, I think you reported 219. Last quarter it was 202. Despite the liquidity coming down, the LCR has remained or in fact improved. Is it largely because of lower outflows in the next 30 days, the way it's calculated?
Yes, correct.
Okay. So for a normalized outflow, let's say the next 30 days outflow may not be significant. For a normalized outflow, what is the like-to-like coverage ratio?
It will be around 150%, what we will maintain.
Okay, sure. It'll be much the levels. Sure.
Correct.
And coming to the cost of fund, that's the stock cost, and I got the cost of fund was 8.7. What is our stock cost of fund today?
8.87.
8.87. Okay. So going forward, I mean, the margin trajectory as we speak, 8.9 is what in this quarter, and if the incremental stock is lower than your stock cost of fund, what should bring down the margins from here? Are you seeing some sort of moderation on yields?
Well, I think as of now there has been some increase. Incremental funds, what we have now seen coming in next few months, between should be around 8.75 to 9%. So I don't expect the cost to come down. It should continue to be at around this level only, between 8.8 to 9% is what I would say.
Okay. No, the reason I'm asking is what's the reason for holding on to guidance of 0.5 that we've already delivered 0.9? Is it like more because I don't see that margins falling from here.
No, it is basically, see, in the last quarter, we will definitely more demand will be there for new vehicle, and definitely some shift in the mix. So therefore, we are giving a conservative guidance.
Okay, sure. Sir, on cost question on cost, if I look at stage 1 ECL cover, that has gone up from 2.9 to 3.1, and that has led to increase in credit cost of around 260 crore. I just calculated. Any reason to increase PCR on standard assets? I think most of the NBFCs work at basis point on standard assets. Why are we 3.1% kind of cover on our standard assets?
Based on the historical data, and also we keep stressing our doing a stress on the portfolio, and this is that. And this, when we do, it's also linked to the inflation and CPI of the country, and this is that there can move in the requirement of the PT, LGT, and PT.
Okay, because it is significantly higher than what we used to keep earlier, and it's higher than all other NBFCs. So, okay, sure. You would like to keep this kind of level?
Around this level, that's what we expect.
Okay. Because if you improve in stage 2 and stage 3 assets, that's also an outcome of strong macros again here. That is kind of counter because if you're
that will, yeah, you're right. So, the improvement in the quality of the assets will get reflected in the sequent periods only. Sure. So we are taking the last 5 years data. This data will get added, and then when we are again rerunning for the next year, then this may be better.
Okay, thank you. The final question, sir, is on loan growth, on the AUM growth. Today in this quarter, we have delivered % growth. YTD is around 9%. And sir, sir always said and always made that 2H is better than 1H in terms of disbursement, broadly 60-40. In that quarter, your guidance of 17-18%. Can we not do 20 or more given that we've already done 20?
We always would like to grow faster, but see, economic condition and the GDP growth both will determine the credit demand. So we don't want to push beyond the what the economy needs. So we are always giving a conservative number, but if there is a scope to grow, we will grow more than 20 also. So we are not hesitating, but the economy has to take that kind of a growth. So we are quite, I should say, very conservatively giving you the estimation.
Perfect, sir. Congratulations again, team, for the quarter and all the very best.
Thank you. Next question is from the line of Abhijit Tibrewal from Motilal Oswal. Please go ahead.
Yeah, good evening, everyone, and congratulations on this quarter. Sir, please first, if you could give two data keeping questions, if you could just give. Am I audible?
Yeah.
Yes, sir. So first, just give the disbursement mix, and if Sundar sir can just give the number that he gave in his opening remarks.
Yeah, the PD for stage 1 is 7.89% in the current quarter, as against 8.0% in the previous quarter. And the PD for stage 2 is 8.21% in the current quarter, as against 8.8% in the previous quarter. And LGD for the current quarter was 41.39%, as against 42.32% in the previous quarter.
And the disbursement mix?
Disbursement,
What do you want?
disbursement.
Disbursement mix, if you...
Okay. So we have disbursed totally 34,000 crores in the current quarter. The CV was 12,782 crores. Passenger vehicles 7,379. Construction equipment was 178. Farm equipment was 550 crores. MSME was 3593. Two-wheeler contributed to 2359. Gold 3051 and personal loans 2910.
This is useful. Sir, a lot of discussion has already happened on margins. You already suggested this kind of margins look sustainable. So just two questions here. One is, would you be able to split this margin expansion of 6 basis points that we've seen sequentially to what came because there is now lower liquidity of the balance sheet and lower negative carry, and what has been driven by increase in the proportion of higher yielding products in the...
Okay, this will take it offline. You can contact Mr. Mundra. He will help you out maybe tomorrow.
Sure, sir. And sir, any one-off from the merger accounting in the NII that we reported?
No, nothing. All of the one-offs are over. There is nothing in the current quarter.
Got it. And so lastly, on credit costs, write-offs, appear slightly higher in this quarter. Anything to read into from asset quality perspective, any disruption you saw from this erratic monsoons that we had?
In June quarter, the number of settlements were lower, and the current quarter, the settlements were higher. It was close to 15 lakh contract we closed, and with an average write-off of around 5,500. This has been trend in the previous quarters also. We have been write-off will be around 5,000 to 6,000 is the broad range that we have been observing in the last many years.
Got it, sir. And so just one last question. Umesh sir said that we have remained conservative in for margins as well as AUM growth. So currently, what's our guidance on AUM growth?
See, the year beginning guidance of 15% will probably hold good, but since we have already grown at around 18% year on 20% year on year, the second half also we should be able to grow at similar level. It also depends upon last year's growth. So year on year, when we compare the previous year's comparable, we need to see. So I feel 18-20% is something good indication for the rest of the year.
Got it, sir. This is useful so much. That's all from my side.
Thank you. Next question is from the line of Viral Shah from India Infoline. Please go ahead.
Yeah, thank you, sir. Actually, I had a question in terms of personal loans. So, of course, within the entire product suite you have, tough products, as you mentioned, they are driving the growth for at an overall level. Within that, the share of personal loans is also increasing. So, in that context, can you give us some more color on the kind of customers you are targeting, some flavor around what the is like? Also, what progress in terms of partnership with Paytm? Have you forged partnerships with any other tech platforms? Like, what's the share of those loans?
So, okay. As far as personal loan is concerned, today it's 100% targeted at my existing customer who has finished at least one cycle of loan with me. So, if you look at the disbursement of the last quarter, which is 2,900 crores, out of which almost 35% of the customers were people who have already taken a two-wheeler loan and a personal loan, and now again come for a second personal loan. Basically, they have closed two loans, they come for a third loan. Repeat customers. I mean, the rest of it is to two-wheeler customers who have finished a cycle, that they have finished their loan and came for it. So, average ticket size in this is for the first time, in the sense, a two-wheeler customer who is coming for a personal loan for the first time would be around 45 to 50,000. A customer who has serviced 2-3 cycles would be around 65,000, 65 to 70,000. So that is the average ticket sizes. On the yield side, it ranges again depending on the customer's profile also, ranges from 20% to 26%. See, as far as Paytm is concerned, the tech integration is in the process. We should be able to complete the tech integration in the next 2 weeks and then start business. One. Second is we have on the tie-up with fintechs. We have a couple of tie-ups with the fintechs where we tied up with one fintech for giving credit to new. Extending credit to new to credit customers, and a couple of fintechs for supply chain funding.
Okay. Got it, sir. Can you basically what's the target you have in terms of scaling up this partnership with this fintechs, whether be it Paytm or the other you mentioned?
So as of now, we have not put a target on this. We wanted to see how business performs for at least 2 to 3 quarters, and then we will take a call on the numbers.
See, Viral, here, as our customer base increases, scope for us to give personal loan also increases. So that is how the opportunity is coming up.
Got it. So one last question from my end over here. So while I can see the gross stage numbers for personal loans is around has been around 5.5%. What's the kind of write-off policy over here, and what's the write-off levels you are seeing currently?
Policy is 100% write-off on.
It's based on the ECL model only. It depends upon the product. There is no. I think it goes based on the historical data.
So what's the policy for personal loans for write-offs, and what's the level of that we see?
See, beyond 12 months, supposing if it's more than 365 days, then we fully write off those assets.
Okay, got it. Got it. To from my end.
Thank you. Next question is from the line of Shriram from Elara Capital. Please go ahead.
Thank you, sir, for the opportunity and congratulations on this. So just taking note from the previous question, did I get it right? Unique customers to Shriram, ticket size in personal loans is 45 to 50,000 rupees?
Correct.
Okay. And just, on this, could dwell more because there are concerns in ticket size below 3,000. I do understand you just mentioned that, most of the customers are two-wheeler, but especially first-time customers, how is your experience on ground in terms of quality?
Let me correct you again. They are not first-time customers. They have already serviced 60,000 rupees worth of two-wheeler loan. They are not first-time customers. So our experience of dealing them is fine. I think the concern mostly in the market is on the smaller ticket is on the BNPL loans. right? And point number 2 is, just to let you know, about 85% of my personal loan customers are either self-employed or small businessmen, right? So most of this money goes towards some small work activities. These are basically, could be your milk vendor, it could be your plumber, electrician, your vegetable fruit seller, these kind of small businessmen.
Okay, understood. And then what is the tip price for the second cycle customer you mentioned?
That is around 60 to 75,000.
Okay. So then my next question is again on new vehicle financing growth. So I remember somewhere last time you did mention that the new vehicle financing growth is also the used vehicle finance customers are getting upgraded. But it's been more than 3 quarters now that we have been seeing new vehicle financing growth of surpassing used vehicle financing growth. And if you look at the market, so most of the NBFC and other players have been vying for used vehicle financing market share. So somewhere we are facing competitive heat, or this is by demand.
Sorry, I didn't get the question.
First of all, our used vehicle market share we are not losing. We are actually gaining market share in used vehicle. So new vehicle, yes, people upgrade. There are some used vehicle owners upgrade, and we do finance. And in the last quarter, in the previous year, normally in the last quarter, more people opt for new vehicle. And every year, if you see in the last quarter, more people opt for new vehicle. So that's the only thing we highlighted in the previous quarter, that because of that, new vehicle mix increased. It is not that we are losing used vehicle market share and therefore we are doing new. It is not correct. We are continuing to grow in our used vehicle, and some customers are upgrading to new vehicle.
Right, so yeah, that's exactly what my question. And the one last question, if I may squeeze in, any additional provisions you have made again due to stress test this way you did in Q1?
No additional provision.
Okay. Thank you, sir.
Thank you. Next question is on the line of Concall from Group. Please go ahead.
Yeah, congratulations for a good set of numbers. Firstly, again, with respect to write-off, if you can highlight in terms of the segments wherein the write-offs would have been higher, is it more coming in from PL segment, or this seems to be more of the vehicle segment itself? So how should we look? And if I read right, is this run rate something which is more kind of a normal run rate of 800-900 crores going forward too?
We have been getting an credit cost of between 1.5% to 2%. Still expect to be in those levels for the full year. And coming to the segment-wise write-off, that I would suggest that you contact Mr. Sanjay, able to help you tomorrow.
Yeah, no, just the sense was whether incremental whatever was there, was it more of a PL? Yeah.
Now, Kunal, I would like to tell you, see, there is a newspaper item saying that the personal loan having a low ticket personal loan having higher risk is something which is playing on all of your mind. I would like to clarify here. We are not in open market for selling our personal loan. We are offering an additional loan for existing customer who has already repaid our loan. That means a track record is established and we know the customer. So we are offering them a personal loan to these customers if at all they need any business needs. This is not for consumption. This is for business. Because 80% of our two-wheeler customers are business people. They need a business loan for working capital or any other business expansion purpose. And therefore, this is given. So I would like to stress here that we are not in open market personal loan just like any other player or any other platforms. We are not there.
Also no BNPL.
And also we are not in BNPL market.
Secondly, when we look at the provisioning difference now between maybe the overall ECL on stage 1 and stage 2, in fact, if you look at stage 2 ECL has actually come off from 7.85 to 7.18. Okay, so not what you highlighted in terms of the LGD and P assumptions. What's actually driving that? Is it more of a quality, maybe the history which you actually rely on for calculation that is under constant change? At the same point in time, stage 1, we are seeing the increase of 15 out there. Yeah.
It's more of a mix of the product as well as the skill model that we run. So it's interdependent upon all this and also the historical data. All these factors contribute to that.
See, Kunal, what happens is, if you go back to last 5 years, there has been a stressful period in the last 5 years. So some of those also will play when we go into ECL model. So if I drop the 5 years and go just for 2 years, then our this one will be totally different. So as Sundar said in the beginning, as we go forward in the next year, definitely if, our calculation will undergo a change. ECL model calculation will undergo change, and the provisioning requirement will come down.
Okay, sure. And one last question on housing finance, doubling of ECL on stage 2 from 3.5 to almost 7.3 in one single quarter. So again, it's more of a change in the assumption, maybe particularly with respect to the PD assumption out there.
Can you repeat, Kunal, again?
No, stage 2 ECL provisioning in housing finance, that has almost doubled from say 0.5% to 7.3 in one single quarter. If you look at slide 38, okay, the presentation. So I don't know maybe what led to this. Is it more of a change PD assumption, and how should one look at stress there in this portfolio? Yeah. If you look at the last line, 3.5 to almost 7.3 in one single quarter.
Kunal, we haven't made any change in the ECL assumption, so I will take this and get back to you.
Okay. Okay.
Yes, I'll get back to you. Yeah.
Yeah, sure. Okay. Thank you. Yeah.
Thank you. Next question is from the line of Piran Engineer from CLSA India. Please go ahead.
Yeah, hi. Thanks for taking my question and congrats. Firstly, just wanted to understand that we've had 5,000 employees this quarter, but our employee OPEX is absolutely so. Any one-offs either last quarter or quarter?
Previous quarter had the change in the gratuity assumption, and hence the cost was higher in the. This is more or less normalized one.
Okay. Sir, can you remind us how much amount was?
I don't have it right now. Maybe you can contact Sanjay. He will help you out tomorrow.
Okay, sure. Secondly, just personal loans, want to understand whether we started cross-selling it to Shriram transport customers or still within the SCUF customer ecosystem?
Shriram transport customers, typically if they need a loan for, say, buying tire or a battery or fuel, we already have those products. So pure play consumption personal loans we have not extended.
We intend to, or that those 20-25 lakh customers are out?
It depends on, we intend to, but it will depend on the customer's earning and repayment ability. It will not be a pre-approved loan that we are going to push.
Got it. And just lastly on the same, because a lot of our PL customers are ex-two-wheeler customers, but when I notice our PL GNPAs are higher than two-wheelers, so what explain that? If customer having a higher delinquency than a customer.
It is just that on a two-wheeler loan, the people feel that it's a secured loan. They have an asset that they have to lose. They may lose. Whereas here it takes a lot of persuasion once they start, getting in delinquent. It takes a lot of persuasion to collect the money.
Basically, two-wheeler loan is average 18 months to 24 months. this personal loan will be around 12 months. So
Sorry, sir, you've gone.
Sorry. So basically, it's just that it's the nature of that's the reason why it's called personal loan. So it's not a secured loan, so people also tend to take it a little easy. So you need to work that much harder.
Got it. Okay, that answers my question. Thank you and all the best.
Thank you. Next question is from the line of Rajiv Mehta from Yes Securities. Please go ahead.
Yeah, sir. Hi. I have a couple of questions, and first, congratulations on very strong set of numbers. So, sir, first question is on very strong, consistent growth in the used passenger vehicle portfolio. And now, can you reason the growth, can you give more color with respect to what kind of vehicles, portfolios, models are growing faster? And secondly, what is the nature of demand? Is it more replacement in nature or is it addition? And third, you can also call out the role of what is the value growth versus volume growth in this portfolio.
See, as of now, the ticket size is definitely a larger one. So that is definitely helping in the vehicle portfolio growth, especially in the passenger vehicle. The diesel prices have gone up by 30%. So that is really helping in the growth. But otherwise also, the reach has also increased for us. The number of branches to offer the passenger vehicle and commercial vehicle has increased. But passenger vehicle is easy sell for most of the erstwhile branches. Therefore, the passenger vehicle growth is faster.
And sir, again, and even MSME growth has been growing, the growth has been pretty strong. I know that we've been gradually, our strategy has been to take it the erstwhile Shriram transport branches for cross-sell. So to call out what is additional growth because of cross-sell that we are starting to see. That's number one. And whether is there any role of excess in this growth being reported?
Yes, it is absolutely not grown. And we also monitor very closely the ticket sizes because we are very conscious of what we do. One. Second is the growth is also because of, as you said, you're right, we have taken it to places where the commercial vehicle branches are also there. So I would say an additional 10-12% growth has come in the loans because of the introduction of these loans in the commercial vehicle branches.
Okay. Just last question is on asset quality. Again, we've seen consistent improvement in our portfolio construct. I mean, 1 and stage 2 percent has improved, which also means that collection efficiencies are going up. So now going into second half, which is generally pretty strong, can we assume that the fresh creation and forward flows will even, and hence the credit cost would be well in the range?
Yeah, we anticipate that it will be stable and it should improve by a few more basis points.
Okay, thank you so much.
Thank you. Next question is from the line of Chandrasekhar Sridhar from Fidelity International. Please go ahead.
Good evening. If I were to look at your yields on advances over the last 12 months, if I, last year you were carrying 5 months of liquidity, of now down to 3 months of liquidity. And, the obviously businesses mix has shifted with some of these personal loans picking up to the MSME. But it seems that, adjusted for that, on a individual product basis, you are not, taken up yields in an environment where, we've had a pretty substantial rate cycle in this entire period. Are we on a individual product basis, are we finding it tougher now to take yields to where they were, earlier or what we used to do earlier?
See, it's not a question of finding it tough or not. We feel products are priced right. So we don't find a reason why we should increase those rates, push the rates up. And we also have to keep the market in mind, no? The other players of the market in the mind, at what rates they are operating and what rates we operate. In fact, if you look at our two-wheeler offering of two-wheeler and MSME, we are actually at a slight premium compared to other players. Two-wheeler, which is a very competitive product, we are at least 100 to 150 basis points more than what our competitors charge. I think they are rightly priced. Unless we have a pressure on the NIMs, we will not look at increasing the rates.
I mean, essentially, it means that there is competitive pressure. Competition is basically you keep yields where they are even in a rate cycle.
I'm sorry, I didn't say that. What I'm trying to get at is, I think the yields that we are getting are very comfortable yields, and the NIMs are also comfortable. So I'm not in a. I think we are in a finance business where these yields are pretty good. I think and the NIMs are pretty good. So we are not looking at pushing this further.
Okay, understood. And while the unsecured business grown 10% on quarter, and you talked about a little earlier about seeing or something what would with a cross sell on PL for even Shriram customer. Just to be sure that you're with the ambit of capping unsecured at 5% of overall AUM. Is that something, or has that the guardrails internally have the shift to maybe a higher unsecured?
We have not changed. It has not changed.
Right. So this 4.3 goes to 5 eventually, and then you want to cap it somewhere.
Yeah. I know 4.3, by the time it reaches 5, the overall pie will become bigger. So we hope that there will always be a gap.
Right. And can I just check on the OPEX? Obviously, you added a lot in the last 12 months. Just some sense on how many more are you going to add, or the cross population across branches and gold loans, the number you add, is that large now done? And on cost to income, get some leverage some point in time, or this is what we should is the cost to income on a steady state?
Cost to income is around 26 to 27% that we have been getting, and we continue to be sticking to the same number. And on the employee addition,
we may add another 1,500 to 2,000 people in the next 6 months. We are also opening up the collection centers. We have about 800 service centers. We are planning to convert some of the service centers into full-fledged branches. But also, we have not yet fully exploit the network for both MSME as well as gold loan products. So it could be an ongoing process, but I think it will be at least another 4 quarters before we look at capping manpower, pushing for yeah.
So the level typically is still is middle of FY25, second half of FY25 to first income start coming off.
Yeah, I think as Sundar said, we are actually looking at a 26% cost to income, so it should stay there.
Right. Okay. Thank you.
Thank you.
Thank you. Next question is from the line of Punit from Equity Group. Please go ahead. Punit, may I request to unmute your line and go ahead with the question, please? No response. We move to the next participant. Next question is from the line of Ankur Jain, an individual investor. Please go ahead.
Yeah, hi, good evening. I have a question on the ROE. So for the last quarters, company has been getting ROEs of 50% plus. So my question is there any target of ROE you have in mind? I mean, some range of ROE over 3 to 5 year period that you want to target?
16 to 18 is our target.
Okay. And what would be the roadmap for that, if you could help?
So next year we should touch 16, then it will improve to 18.
And does it include increasing the debt to equity ratio?
Yeah, as we grow, there will be increase in debt to equity ratio.
Okay. Yeah, thanks. That's it.
Thank you. Next follow-up question is from line of Puneet from Macquarie Group. Please go ahead.
So thank you for taking my question. Just on the yield bit, what was the increase in yield? If you could highlight that.
Cost of fund has not gone up.
Okay.
On the yield, there has been
around 30 to 40 basis points increase in the yield and some increase in the cost of funds. And we also got an advantage of the carry being lower because of the lower utilization of securities.
Yeah. So that bit also, your incremental cost of fund was lower than your total cost of. So you said that the product mix might drive a decline in margins. Would that suppose it was the way calculating it looks like margin should be upwards even after reported. So any comments on that?
No, I think what Umesh mentioned was that in the third and fourth quarter, the new vehicle sales goes up. So the new vehicle funding will go up. That could basically, since new vehicle are lower yield products, he said the NIMs could be, he says we stand by a guidance of 8.5% NIMs.
What? Okay. And what was used vehicle and new vehicle growth?
That I will give you. I have a CV as a whole has grown by about 14%.
Okay. Tomorrow you can just contact Mr. Sanjay. He will help you out.
Oh yeah. Okay. Thank you.
Thank you. Ladies and gentlemen, that was the last question. And now hand the conference over to Mr. Umesh Revankar for closing comments.
Yeah, thank you. Thank you for participating in the call. We do expect the next second half of this year will be robust. Already the indication is that festival demand combined with cricket fever is creating visibly good credit demand. And with the economy being strong and all other parameters remaining good, we should be able to grow faster in the second half of the year and come with a good set of results next quarter. See you again next quarter. Thank you very much.
Thank you very much. On behalf of Shriram Finance Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.